Good morning, everyone. It's Monday, December the 15th, and welcome to 7 Investing Live. This is our interactive live stream event where we showcase several of the stock market's most intriguing opportunities. My name is Simon Erickson. I'm the founder and CEO of 7 Investing. We started back in March of 2020 to empower individual investors to find and invest in the stock market's greatest opportunities. Really thankful you're here for this live stream event. We wanted this to be short and sweet. Know that time is at a premium, but just in 15 to 20 minutes, 3 times a week, Monday, Wednesday, and Friday, again at 10 a.m. Eastern, we're going to talk about a different topic, and we're going to talk about some investing opportunities that come from that. And we want this to be an interactive event, so feel free to ask questions or chat on the sidebar. We publish this to our Twitter account at 7innovator and also to our 7 Investing YouTube page as well. So let's get started with today's topic. Today's topic is going to be about consumer spending. It is the holiday season that is upon us now. May your days be merry and bright. Hopefully, you're seeing a few of those Amazon boxes, being dropped off at your doorstep. I know they are here at the Erickson residence. I don't ask what is in them. I don't think I want to ask what's in them, but I know that some of them will be under the tree in a couple of weeks. And consumer spending the holiday quarter is always one of the best for retailers, but perhaps they might be a little bit less merry and a little bit less bright for some of those retailers here in 2025. We're going to explore the consumer discretionary funk that America is currently in and how that might have an impact on several stocks. The stock that we're going to focus on today, the stock on our radar, is Crocs. So we're going to be talking about that one. We're going to jump into this data in just a minute here. We see that this is a McKinsey study that we saw out there. Thank you to Heather Horton, a shout out to her, our producer of the show, that's showing that, out of people that are spending money for the holidays coming up here, are you spending more this year than you typically do, or are you spending less than you typically do? And for the most part, the economy is kind of in the gray zone in the middle, right? About the same as before. But we do see that this year, as opposed to previous years, several consumers are not spending more on several different categories, and they actually are planning on spending less. And certainly on some of the discretionary things there at the bottom: food delivery, entertainment, meals, apparel, electronics, furniture, jewelry, and decorations and accessories, right? This is the truest of consumer discretionary spend that is 70% of the American economy out there. And of course, as Amazon and Walmart and other retailers are out there are looking at these numbers, we always want to see the American consumer coming in strong, spending lots of money on the holiday, spending it across the board on different types of categories. But perhaps this year might be a little bit less exciting than years past. Now, why might that be? We've got some other data that might be interesting too that could be contributing to this. The first of all is unemployment data. We looked at the Bureau of Labor Statistics. The BLS data for unemployment show that the unemployment rate is now up to 4.4%. There it is. You can kind of see it ticking up about 100 basis points, 1 percentage point over the past 2 years. This is unemployment across the Americas, across the United States. We've seen that for a variety of reasons. Certainly tech companies have been laying off tens of thousands of employees here during the last year. And the payroll numbers have displayed that. In fact, non-farm payroll has been coming a little bit lighter than a lot we're hoping here in 2025. We did see the Fed cut rates in the last meeting here by quarter point. That's fantastic, but still, unemployment CPI index, as you can look at it right here, is still at that kind of stubborn 3%. We have yet to get down to the same CPI inflation rates as you saw there pre-COVID, pre-2020. We know that they got pretty aggressive there for a little while, 7% plus, but they're still kind of at that 3% rate. And, we've got tariffs. We've got an issue that's kind of impacting a lot of retailers. Supply chains are kind of shifting as there were threats on tariffs for China, for Southeast Asia, for all different countries around the globe. And that's pushing up the prices of a lot of goods that people are having to pay for here in the United States. We saw that people are kind of reacting to that. When you got higher unemployments, you've got 3% plus inflation, you've got tariffs pushing up the prices of things. What do consumers generally do? They tend to pull back a little bit and spend a little bit less. And this has been an issue for publicly traded retail companies, right? A lot of companies have actually been struggling through most of 2025. We're going to do a little rapid fire that's going to show a couple charts of how revenue growth in the Americas has looked for several retailers. The first one there is Crocs. CROX is the ticker on that one. This is the plastic shoe company. We'll be talking in more detail at the end of the program, but look at that continual trend downward ever since the end of 2025, right? From mid-single digits to now kind of high single digits and a decline in year over year Crocs branded revenue in 2025 compared to 2024. Let's look at another chart. Let's put another one up there, see what we've got next. The next one we've got is Under Armour, right? Another footwear and apparel for fitness company. Improving a little bit here. You can see it's certainly not as bad as it was in mid of 2024, but for the most part, Under Armour has been reporting for the last 18 months or so double-digit declines in revenue in North America. That North American consumer is probably putting off purchases of new athletic apparel and certainly new footwear. What else do we have? What's another one that we've got that we wanted to show up there? Nike, right? The quintessential America fitness brand, international growth story. Really big in China, but the American consumer has been struggling for Nike ever since late 2024. You can see that high single digit, maybe low double digit negative decline in North American revenues for Nike. You did see Elliott Wolf coming back in. You've got a new CEO that's going to be improving things and hopefully turning them around for Nike, but still a challenging environment for that. And then even Lululemon, the company that kind of made its roots in yoga apparel, in fitness apparel, especially for women, kind of expanded its fitness brand to go elsewhere, really has kind of struggled in the last several quarters, right? Other than that high note there in February, we've seen just now a negative decline in America's revenue in terms of year-over-year percentage change. In fact, Lululemon's founder, Chip Wilson, took out a page in the Wall Street Journal to basically criticize management and say that there's a cultural change that has to happen in Lululemon if it wants to remain its edge. That prompted Calvin McDonald, the CEO of Lululemon, to actually step down in its most recent quarterly results. As you see there, now a negative decline, a negative 2% decline in America's revenue change for Lululemon. Again, this is a company that was kind of at the peak of premier consumer discretionary spend. What I mean by that is very, very high price points, very, very high margins. And thanks, Heather, for showing some of those graphs. Kind of showed you that a lot of these retailers are struggling. It's not just a specific company, but kind of across the board. We've gotten used to seeing negative, declines in same-store sales in the retail outlets, and then overall negative revenues in the North American segment for a lot of these different retailers. Now, the question for us as investors is this a temporary issue related to the economy, which is, of course, hopefully not always going to be seeing unemployment tick up, not always going to see a year where we're having aggressive tariff rates, and not always going to have inflation, it's 3%, 4%, 5%, always ticking higher. Is this just a state of the union of the economy of America that's going to go away or at least improve in 2026? Is this a short-term issue, or is this something that's going to be a prolonged, long-term downturn that's going to affect a lot of these retailers for several years? I tend to think that these things do go cyclically. When the economy improves, retail environment certainly improves as well, and you see a lot better numbers, especially when you're coming off of a down year for comps. You see a lot of those revenues and those same-store sales numbers are down right now. But in 2026, you're going to have a much more favorable comp to the bad year that was 2025, right? We're probably going to see growth for a lot of those. And of course, you want to show a positive number rather than a negative number when you're showing your year-over-year comparisons, especially to Wall Street out there. So some of this is short-term factors, but then also I think there's some long-term factors that are actually really good for retail as well. The first is the valuations have gotten very, very attractive for investors. If you're wanting to buy a retail company, you're not wanting to buy at the peak. When the earnings are showing their best numbers out there, the denominator of the PE ratios is very high because it's a really, really good year that you're reporting out there. You want to buy, when times are really difficult and when consumers are cutting back on spending, and a lot of these companies are actually really, really having a tough time. That tends to separate out the strongest companies who are going to survive and thrive from those that are just not going to do as well. And then the second one that I think is going to be very intriguing is something that we haven't really talked a lot about in retail, but it's going to be the impact of AI. Now, yes, we know that AI touches every sector of the economy out there. Retail is one of many that's going to be adopting this out there. The AI models made by ChatGPT and others, they're embedding their way as a technology that's going to be fundamental for a lot of different sectors. But we've also seen that for the numbers to make sense, for OpenAI's aggressive expansion plans, which we highlighted on the program last week, they're going to have to embed advertisements within the core OpenAI platform, right? GPT is going to have ads, and it's going to be the same approach that Facebook and Google took in decades past, where it's going to still remain a free service for us as users, For those that have used GPT, you're probably not paying anything for it for the most part right now. It's got almost a billion users. Last time we checked in, 900 million free monthly active users are using GPT, and 95%, approximately 950 million users are not paying anything for it. The paying subscribers is still only 5% of the overall population. So how does OpenAI going to monetize those free users? Well, certainly it's going to start embedding advertisements into free users. And for the most part, if this is a direct to consumer play, B2C, if you want to call it that, it's going to have the same type of advertising that Facebook did, that Google did. It's going to try to profile us as a person who's using GPT and figure out what it is we're most interested in buying and having sent directly to our doorstep. And so I think this is very good for the retail industry because who is appealing to consumers? Who is wanting consumers to spend more to buy for them? It's the companies that we just profiled out there, right? It's going to be Nike, it's going to be Under Armour, it's going to be Crocs and Lululemon that are going to be actually placing the advertisements within GPT to try to get the conversion rates and improve their sales in 2026. So I think that between us being in the short-term funk that we're in, the valuation multiples, which we're going to talk about here in a moment, and then also the long-term impact of advertising going into our artificial intelligence models, such as ChatGPT. I think that all of these are pretty favorable for the retail environment and consumer spending stocks in the year 2026. I think it's a good buying opportunity. And we could have talked about any of those 3 or 4 or 5, depending on which one we looked at. But I want to talk about Crocs as the stock to watch here in the focus company that we're going to discuss a little bit more on today's program. First of all, I'd like to put up perhaps a related story with Skechers. We do have some headlines from Skechers earlier this year that this is a company that was another shoemaker, was going out there making comfortable shoes, walking shoes, things like this. And look at this. Skechers back in May announced that it was going to be acquired by a private equity company, 3G Capital, very, very large, prominent company out there, for about $9 billion, $9.4 billion enterprise value. And that was just more than 1 times sales and about 13 times earnings, according to Skechers' most recent company updates. The shares were taken private, so this was going to be a premium of about 25 to 30% of what the shares were trading at in the previous day, about a 30% premium for this publicly traded stock in the retail sector. And Skechers seemed to like it was doing just fine. It was capturing about a 9% profit margin, net profit margin. Was not as high as several other players out there, but it did take the offer. It said, we're going to go private. We're going to get away from a lot of this kind of tariff uncertainty and all these kind of things out there. So I think that is kind of a floor for the stock right now. That if you see something like that, like Skechers, which is larger, about twice as large in terms of sales as Crocs is, I think that's kind of a nice little floor that you could also see your stock taken private, for 13 times earnings, for 1 time sales, whatever the number might be. And even at that floor, Crocs appears to be at least 50% undervalued. But let's look a little bit closer at Crocs right now. Crocs actually pulled its own guidance for the end of the year amid the tariff uncertainties. In fact, it announced earlier this year it's going to withdraw its fiscal 2025 guidance on the tariffs uncertainties. It did actually beat in the quarter that it reported there, had higher profits, but lower revenues in the first quarter when it withdrew guidance. It's come back and has been a little bit more optimistic in the second part of the year, saying that, hey, it's going to reroute some of its supply chain, get away from the 25% of its manufacturing that's done in China, reroute that to Vietnam and Thailand, and then keep the North American supply chain mostly intact. But overall, I think that Crocs, which is capturing right now a 22% operating margin, is in much better shape than Skechers was. That's 2.5 times a higher profit margin on the operating line than this company that just went out and got acquired for a 30% premium. Crocs is certainly capturing a pretty decent price point for these plastic shoes. And anybody who has Crocs, I certainly know that our family has plenty of pairs of them here, knows that you tend to make repeat purchases of them over time. Not only are they kind of a fun brand that, has got an endorsement, a following of people that tend to like them, kind of a goofy brand, but you buy the gibbets, you buy the little things with NBA teams, or maybe your favorite comic character, or maybe your kid's favorite cartoon that you put on the shoes, and it kind of brings a fun personal aspect to them. And when you buy a new pair, you pop off those plastic gibbets, you put them on the next pair of Crocs that you buy for $50. Pretty affordable price point for kids' shoes that last for a long time, at least until their feet grow to the next size up. And so Crocs, you've got a loyal customer base, you've got a good price point, you've got 22% operating margin, like I mentioned, 27% ROIC, which is return on invested capital. This is a very profitable business that's churning out plenty of cash flow for the $4 billion of revenue that it sells from the 150 million pairs of shoes that it sells across the world every year. Doing very, very well in China. The American consumer is a little bit struggling right now. And they made a bad acquisition a couple of years ago in 2021 of a company called Hey Dude. Hey Dude was outside of that customizable, fun, plastic shoe and plastic resin that Crocs has been known for in its namesake brand. I really wanted to try to get out there and use this Italian kind of foam, very, very soft, very comfortable leisure shoe that it thought was going to catch on with the younger generation. And so it hired a whole bunch of influencers to appeal to this younger generation, which it just didn't work. Younger generation, turned their back on Hey Dude, said this is not the shoes for us. They compared them to Kleenex boxes. They said they were overpriced. It just didn't catch on. And Hey Dude has been struggling for several years. So Crocs did the conservative, responsible thing as a corporation, and it impaired this brand. It wrote down the goodwill of the Hey Dude acquisition in the most recent 2 quarters. Both quarters actually wrote down the investment in Hey Dude. And it is attempting to turn things around, but it's not selling primarily through wholesalers and shoe companies anymore that are local. It is now trying to sell more direct to consumer online. It hired Sydney Sweeney, a very popular American actress, to be its brand ambassador from a marketing perspective. Its chief marketing officer of the Hey Dude brand comes from Stanley Cups, which has also been a very successful turnaround story in the last couple of years. So I think that, between Terrence Riley, Sydney Sweeney, you've got the right people on board. I think that there is a little bit of a turnaround that's required for Hey Dude, but perhaps it's not going to try to be all things to all people. It has a nice little sector in viral marketing that is working in direct to consumer. But whether or not Hey Dude works or it doesn't work, and whether or not Crocs is struggling here in the short term in North America, the stock is priced at 6.5 times its trailing free cash flow. And I'm going to pull up a graphic here, and we go right to the 7investing site to show you kind of why we think this stock is so interesting. We'll go ahead and pull this up. There's a 7investing site. You can always check it out at 7investing.com. And then if I just wanted to put in Crocs, I'll put in CROX. That's the ticker of interest, 7investing.com/any ticker that you want to use. We can go directly to our landing page and follow along with the company, including the conviction rating if you're 7investing subscriber. Why is Crocs a best buy conviction rating right now? This has not been a very good stock chart. But again, when you've got a company that is so extremely undervalued, I think this is a great opportunity to turn things around for an investor. And again, here's some of the things that we mentioned earlier on one of our subscriber company updates in February of 2025. Company with a 70% return on equity, a 25% return on invested capital, now selling at a price to earnings of 8x and a price to free cash flow of 7x. And you heard that I just said a lot of those multiples have actually improved even better in the last couple of quarters. And what is the company doing with its money? Well, it's actually buying back a lot of stock. We mentioned back in February that the company had authorized a new $1 billion share repurchase program, which would go quite a far way, buy back more than 20% of the company's outstanding shares. And so let's look at this a little bit further. Now we're going to dig even deeper in. We're going to look at Y Charts, which is one of our partner organizations here, and look at the fundamentals of Crocs' stock itself, right? Hopefully you're able to see this chart. You can kind of see revenue at $4 billion there, the orange line. You can see the free cash flow at $716 million over the last 12 months. So that's a blue line. Those have steadily increased over the last 10 years of this chart. But look at the price to free cash flow, the green line. We're used to seeing Crocs selling at kind of a 15x trailing free cash flow. And for it to be at 7 times free cash flow now, 6.5 times just a couple of weeks ago, this is a company that's saying, hey, if you're not going to buy our shares out there in the open market, we're going to buy them back ourselves. We're going to use our own money to repurchase shares. And that's exactly what they've done. Look at that pink line, the average diluted shares outstanding, steadily decreasing from 76 million shares a decade ago down to 59 million shares today, bought back about a third of its outstanding share count. Bought back about 25% of its outstanding share count during the last decade. Really encouraging to see a company like this that recognizes its best capital allocation move isn't to go out there and make another big acquisition like, hey, dude, that didn't work so good. Isn't best to go out there and just throttle up marketing. People aren't responding real well to that right now anyway. What is Crocs doing? It's doing the most responsible and conservative thing. It's buying back its stock that's priced at a very, very attractive multiple right now and reducing that share count. Why? So when it starts reporting, better revenue growth, better earnings growth in the next year or two, you're going to have a reduced denominator, fewer shares outstanding. So those earnings per share, that free cash flow per share, it's going to look even more attractive and be even more lucrative for Wall Street. So I would love to see Crocs stay independent right now. I don't want to see them come out there and get bought out like Skechers did by a private equity company. But I do recognize that the floor right now suggests probably that the stock is about 50% undervalued. I think it is probably a doubling of the stock price here today at $90 a share. I think there's plenty more upside for Crocs going forward. If you want to follow along with that one, it's 7investing.com/Crocs. And if you do want to see more of our conviction ratings, why Crocs is a best buy right now, which, by the way, is probably off the radar of most investors who aren't interested in this plastic shoe company or looking at AI data center spend instead. But why is Crocs a best buy? Well, check out all of our conviction ratings and all of our 5 monthly best buys at 7investing.com/subscribe. That's where you can get started. You get your first 7 days completely free. That gives you access to all of our premium content. Again, all the best buys, all the monthly conviction ratings, including Crocs and including all of our newest recommendations and our updates on all of our companies on our scorecard. I'll take a breather at that. 20 minutes in. Heather, I'm going to open it up to you. If you have any questions or if we have anyone in the audience that wants to ask about Crocs, about retail, about Amazon packages showing up on the doorstep, what are we thinking about consumer spending in America right now?
Hi. No questions as of yet, but if anyone has them, please drop them in the chat on the sidebar. I think it's definitely down. Everyone I know is cutting back for Christmas, but I will tell you, Crocs was my mom's pet stock. She learned to invest because of Crocs, and I learned about investing because of Crocs.
Can you elaborate on that, Heather? This is unscripted, so I'm putting you off the spot a little bit, but how did you learn about investing from Crocs? That's very interesting.
My mom loved the brand. I think they were out of Boulder, and she grew up in Boulder, and she loved the shoes so much, which obviously was very embarrassing to me as a teenager. They weren't cool yet. And she was just obsessed with them. And so she found they had a stock and she was like, I'm gonna buy it. These are the next big thing. And she bought in the stock, not much, and just talked about it constantly. And that's how I learned all about public investing. And then she sold it on a massive drop and lost pretty much everything. And I also learned, don't sell on drops. That's a bad idea.
Very good point, Heather. In fact, you gave me kind of a perfect opportunity to show the chart again. I'm going to show that chart one more time because most people would think Crocs is just kind of an up and down stock. Maybe does okay in certain years, but not so good in other years. Let's pull back up that chart of 10 years. You can see the price kind of hovering, for the last several years that are at $90 a share. But let's look at the normalized percentage change over the last decade. Crocs' stock over the last 10 years is up 6,460% for a company that's selling plastic shoes that are not that cool, that are probably growing in most years, 3 to 4 to 5% right there along GDP. How is a stock like that up 6,000% over the last decade? And the answer to that is because of buybacks. This is the same strategy that a company called AutoZone, for those who are familiar with AutoZone, has followed for the past decade. If you're gushing cash flows and your stock is extremely cheap, what do you do with it? You buy back your own stock. You retire the share count so that everybody has got a slightly larger piece of the pie every single quarter, right? And so that's what Crocs is doing. That's why they just authorized this $1 billion repurchase, the largest repurchase authorization they've ever authorized in the history of the company. As you mentioned, Heather, a really long-term, financially conservative management team right there out of Colorado. That is correct. And just a company that's done very, very well for its investors the whole time. And it's all right there around being, realizing it doesn't need to grow 30 or 40% a year. It needs to grow 3 or 5% a year, gush cash flows, keep margins high, and just buy back its stock. So really an interesting long-term growth story. I'm glad that you profiled it as one that taught you to be an investor, which we didn't even know we were going to be talking about here today, but that makes it even better. CROX is a ticker for Crocs. Appreciate everybody for tuning in for this one on consumer spending. This has been kind of an interesting time for the economy. We wanted to talk about retailers here on this show. We're going to talk on Wednesday. We're going to continue this same trend of consumer spending, but we're not going to be looking at direct to consumer shoes. We're going to be talking about restaurants. We're going to be talking about going out to eat and whether consumers are also pulling back on their monthly tab on going out to restaurants and out to eat. We're going to be talking about Chipotle on Wednesday's show. Certainly a long-term fantastic stock to own that has been struggling here in the short term. CMG is the ticker for Chipotle. I'm looking forward to digging in to that one on Wednesday as well. So I appreciate it for tuning in for this edition of 7 Investing Alive. Once again, every Monday, Wednesday, and Friday, 10 a.m. Eastern time. Want to keep these short and sweet, be respectful of everybody's time, but also give it a bang, give you a bang for your buck on the time that you spend here with us. Make sure we're getting some good insights and some good ideas for your investing radar out there. Crocs is the one that we profiled here on December the 15th. Once again, my name is Simon Erickson, founder and CEO of 7 Investing. You can learn more about our company at 7investing.com. And if you're interested in taking a 7-day free trial, check out 7investing.com. Subscribe. We'll see you again on Wednesday. I hope you have a wonderful day. We'll talk to you again soon.